So that strategy allows us to swiftly buy as many times as we can and stair step our investors' equity as many times as we can in 6 months to a year per property.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in. All right, welcome back, listening audience. Thank you again for joining another episode of The Freedom Point. I'm your host, Jeremy Dyer. Thanks again for jumping in again today. I've got a wonderful guest with me today, Patrick Grimes. Patrick, welcome to the show.
Thank you, Jeremy. Looking forward to our chat today.
Yeah, absolutely. Me as well. This is the first time that I've met Patrick before, but he's got quite a long track record and experience in real estate that we'll certainly highlight, on the show today in terms of what his background is. But just a little bit of a highlight on Patrick. He is the founder of Passive Investing Mastery and Invest on Main Street. Patrick is involved with owning and managing and operating over 4,000 units, which equates to over $500 million in real estate in his active portfolio. He's also a best-selling author, which I'm really excited to get to know a little bit more about the book that he's authored as well. So again, without further ado, appreciate you joining the show here, Patrick. What are some maybe some other things that you can tell us a little bit more about yourself and maybe kind of your overall investing journey?
Yeah, well, actually, I was an engineer, machine design, automation, and robotics originally, probably like many of your listeners, working real hard, saving up and then trying to find the best places to invest. And ultimately found my way into real estate, had a little bit of an ups and down, topsy-turvy, lost it all, came back. But, I, just like many of your listeners out there, or it's why our company, Passive Investing Mastery, is all about learning how to invest in alternative investments and diversify out of the stock market. I'm, been on that same journey my life, and it's worked out for me. So I'm excited to share that with others.
Yeah, you mentioned that there was a point in your life where you lost it all, and then you were able to bounce back from that. So let's just dive right into that, story. What happened? What were some of those lessons learned, and how are you able to transfer, what you learned through that experience to maybe, how you view real estate investing today?
Well, so I was a mechanical engineer, fresh out of college. I was eager and earning income to invest. Was looking at startups, and I was doing robotics for one-of-a-kind machinery, new products, innovation stuff. So I was kind of in this startup world in the Silicon Valley and looking where to make it big, invest early. And it was the founder of the company that I worked for right out of college that said, "Hey, I didn't invest in these startups. That's not how I made my money doing custom machines and mechanical engineering stuff. But I invested everything in real estate." I was blown away. I learned at that point about real estate. And so unfortunately, it was back before 2009 and 10. And so I got really over my skis in a pre-development. And unfortunately, it hit real hard and I lost it all. So I was a personally guaranteed in a high leverage situation. And the value of the properties just went upside down. The builder stopped. Wasn't much you could do back then, right? I was paying for almost a year or two before I finally found an attorney that said, "Hey, look, just stop or else they're not going to talk to you." They wouldn't negotiate. So I ended up settling, going through foreclosure, and it was embarrassing. But yeah, I was still a high-paid engineer in the space, so I just got a little too eager too soon, and I got a master's in engineering and business, started investing again, and learned how to do it in real estate in a much safer way.
Sure. Let's talk about in a much more safer way. So the challenges were maybe over leveraged at the time. Obviously, I assume that you're speaking about, kind of the '07, '08, '09, recessionary period, where you kind of got in over your skis. What are some of those, lessons that you learned related to leverage, related to, you know, during times of uncertainty, at different stages of the economic cycle? Obviously, you got burned, back in that time period. What are some of those things that our listening audience can maybe glean from maybe the challenges that you faced?
I was speculating, as it turns out. I was buying land that, while it was in a very hot area and there had been tracks of buildings built on a progress, that I was hoping that after I bought it, it would cash flow eventually, that I could get it entitled, that I could, put get the roads and the pads and the utilities in there and then build. I was hoping I could get a loan at that point to build, and then I was hoping that we would have something there that had value more than the loans, and I was hoping I'd be able to rent it for cash flow or sell it for a profit. And there's a lot of hope. There's like a cascading amount of hope. And that turns out to be very speculative. And it's very different than calculated investing for cash flow but in existing assets that you can cash flow on day one, but maybe they're underperforming. Make a calculated improvement, and you're not going to get rich quick. You're not going to double and triple your money every year like I was hoping to back then, but it would be the tortoise, not the hare. And there's layers behind the onion from there. Recession resilient markets became a major focus of mine. And so if you look at I just did a webinar on lessons from past downturns on our platform, Passive Investing Master, and I pulled up all the ebbs and flows of different markets and different downturns, and how you can, in a secured debt position like our debt fund versus an acquisition equity position, how you would fare in different markets, right? And the risk profile of those, and how to choose markets from an economic standpoint that'll be resilient. And then it's how to choose the assets, right? And from there, then it's, can you get the right financial foundation in place with the right kind of debt, right kind of insurance, right kind of reserves, so that you can ride out a downturn if one happens. So there's a lot to talk about there. And so, but being humbled early and being the engineering analyst that I am, it put me on the right path at that point, and I was able to scale from single family on up to larger multifamily, and diversified into energy from there. So it worked out.
Let's talk about this concept of recession resilient. And when you refer to recession resilience, I assume you're referring to, maybe not just the market location that the asset's located in, but even the asset type itself, right? Whether it's a multifamily or some other asset class, and specifically maybe within multifamily, that's your A class, B class, C class, type investment. So let's talk a little bit more about what the ideal recessionary asset or market location is, according to kind of what your playbook has consisted of.
Now, the playbook has changed a little bit just in the last year, and I'll probably put it in some context. If you look back, 10, 20 years, what we would call, workforce housing, which is not the new downtown high rise or the brand new garden style apartment, A class, and not the D class, which are, beyond 50 years or in really rough neighborhoods, but, 20 to 50 years old, workforce housing, blue collar. Those were really the most stable, because people in a downturn will move out of the A class, and you see compression, more people wanting to get to that B and C class. They've been around long enough to buy them run down, and you can fix them up, so there can be some upside there, right? So that typically was it. So that kind of workforce housing, B and C class apartment buildings. I went 3-bedroom, 2-bath, because those are actually among the most resilient assets, single family homes. But then I looked anywhere in between that and 80 units, 40 to 80 units, depending upon the market. It's a kind of a no man's land where the lending's not great. It doesn't have economy of scale. The property managers and quadplexes, and it just doesn't make sense until you get to 80 units. So you get to 80 units, then you have on-site property managers, you have on-site maintenance, the leasing, get better debt, non-recourse. It's a business valued based on its income. A lot of things change. So if you're at that, call it 80 to 300 unit, the 200 is potentially the best economy of scale in an apartment building. Now, the difference just that we saw during COVID, which was new, and keep in mind, like I just wrote an article in Forbes, the upside of downturns, recessionary acquisitions. And it's really cool because I kind of go through the layers of kind of the past way that you looked at recessions versus the new, right? Because new, you always want to protect yourself because a lot of the assets that we would buy, they're from people that didn't have the right financial foundation, which we talked about. They're not the right kind of debt, right? Or they didn't have the right kind of insurance. Maybe there was a fire or a flood. And they didn't have the right kind of reserves. They didn't have enough to be able to ride it out. And so a natural financial disaster struck, and they weren't built on they were built on a bit of a house of cards. They say when the tide goes out, you can see you swimming naked. Well, if you built an investment portfolio that could survive 2008-9, then it would likely survive 2023 and 2024 and 2025, right? But it's different. It looks a little different, right? The difference is it's a financial disaster, but instead of a big swooping devaluation, if you put it in recession resilient markets where we see an influx of people, or we see an influx of jobs, then it's a little bit of padding, right? Helping to stabilize that. If you got long enough debt and your debt's not increasing because of interest rates and you can ride it out to the other side, then probably okay there. The difference this time is the financial disaster comes in also in the inflation, and because of COVID, that disaster caused a delinquency issue, right? We're seeing. So you have a major hit to your income and a major increase to your costs, right? And so that's compressing that net operating income in a lot of buildings that create value. And so it's really tough right now in that even in the B and C class, right? If you didn't structure it right to write it out, you're going to have a hard time. I think that's where it provides a lot of opportunity for like our acquisition fund to kind of jump in and do some stuff. But so it did change up. Like the theory of yesteryear, workforce housing, it was great to buy even a year ago, 2 years ago, 3 years ago. Hopefully you bought it to ride this out, but I wouldn't buy it today necessarily because those are the ones that if you're looking to improve, it's just the economics just don't work out like they used to.
Let's talk a little bit more about kind of some of the distressed assets that your team may be seeing coming on the market. How is Patrick Grimes taking advantage of the current economic landscape in the multifamily space specifically, and that's related to those distressed assets that are coming available?
Well, so there's really two parts. First, we're looking at performing properties, right? Not distressed assets. Performing assets with distressed owners. Mm-hmm. Individuals didn't quite plan, or maybe they got unlucky, their debt's coming due right now. There's $1.5 trillion in debt coming due by 2025. It's a really rough time for that to renew your loan. People that are willing to exit or need to or want to exit quickly, we can be the financial relief to performing assets that are owned by troubled management. And so that's why I'm trying to say there's a difference between a really solid performing asset and whether or not the owners are losing sleep, right? There's a lot of reasons why property might be doing just fine, but it's the owners that are struggling. And so we're in an opportunistic fund, two of them. One is, and we have a pipeline, which we've always had, which now's on full throttle and bringing in these opportunities, which either bring in operators, owners, which are looking for financial relief in one of two ways, right? One is they want a bridge loan, a gap loan. They need time, and we can, if they can do a transactional gap or bridge loan, and we can provide debt to help them hang on to the property, and we could be like the first position on that property. We can replace their existing debt or refi their existing debt. Or somebody wants to buy a property that they don't have time to raise the capital, so they're willing to go at a little higher interest rate. We can provide our PIM Rapid Lending is our company. We provide quick rapid lending. And we can provide financial relief through a debt product. That's what our income fund is, real estate asset-backed debt. If they come to us and like, nope, we don't want debt. We just want out. And when they're willing, and they're willing to move quickly, and they're willing to walk away, and that's why we go direct to owner instead of through brokers. They're willing to walk away with a really solid base for our investors. Then we buy in cash, and that we just, on their last asset, after we completed due diligence, we closed in 14 days, in cash. And so immediately, what's brilliant about that in the acquisitions fund is that you can do that. You can make your return on the buy, right? You can make the return going in. You don't have to hold and hope for 4 or 5 years that millions and millions more in CapEx turn into rent growth, that turn into valuation at a really rough time when valuations are lowering and rents are lowering and costs of renovations are going up. So we're not doing the 3 to 5 or 5 to 7 year. We're buy-in where we're calculating the return on the buy. And then when we go in, we're refinancing out half our capital, buying another property and selling the first asset to a third property, maybe infusing more into those and then moving forward. So that strategy allows us to swiftly buy as many times as we can and stair step our investors' equity as many times as we can in 6 months to a year per property. While we can do it, because we couldn't buy a lot 3 to 5 years ago like this. We could buy a lot now, but probably not in another 3 to 5 years. So buy as many as we can in this 3 to 5 year time frame. So it's really the source of relief, equity, or to buy it or provide debt.
Thank you for that. With respect to investor relations, what are some of the things that you guys maybe do or do differently than other operators when it comes to due diligence to really give your investors kind of that confidence or peace of mind that the business plan that's being executed, is going to come to as close to fruition as possible, or that you're going to exceed, those return projections?
Yeah, well, first of all, we're calling it what it is, and I'm not trying to tell people I can hold a property for 5 years and calculate. I'm telling the truth. My crystal ball for valuations in the next 3 to 5 years is shaky. And I'm telling them I can't just dump millions of dollars into CapEx and turn it into rent growth and turn it into valuation and produce a return. So what's left, right? What's left is I can buy right? Like I bought a property, we just all cash, almost about $4 million. It appraised for $5 million right after, cash flowing at a 10 cap, and it's 60% occupied. After occupancy, the appraisal showed about an $8 million valuation. We haven't put any money into it. So when you can't do something and you can't demonstrate that you can create value, just be real about it. Don't keep doing the same thing over and over. Like I don't think the whole 3 to 5, 5 to 7 year plan in my calculus works out. It doesn't pencil. But I know that if I just straight up with the investors, and I just did a couple webinars on our platform to explain and show graphs and data. I can know, if I can know going in, and then eventually, what my return is going to be, and I can do that over and over until one day I can't, then I can honestly go to my investor and say, here's your projections. It's an open fund. You can redeem when you want, but we'll do this as long as we can, right? And it's opportunistic. So when the opportunity is not there, we're going to dissolve fund. But in the meantime, it's the upside of downturns. And that's on the acquisition side. There's a different answer on the debt side, but does that answer your question on acquisitions?
It absolutely does. Yes, thank you.
On the debt side, it's a lot easier, right? Like I said, I go through very clearly the valuations in different markets and how they swung down. Well, originating a loan at 50% loan to value in the markets we're in, even in 2008, in some of those markets, wouldn't even have dropped to where we're at 50%. If you look at the math, somebody goes into a 50% loan to value loan, right? And the valuation in the market drops by 15%, right? The common equity, they lose like 30%, right? But the debt lose nothing. So on the real estate asset-backed debt fund, where you got your senior secured note or Class A shares on mostly first position, diversified pool in resilient markets, it's tough. it's tough to lose money. It's tough. I don't even know. An investor asked me how it's possible he could lose all his money in fund. I'm like, actually can't answer that. I don't know. Like, how could that be? It would mean like every asset in the fund would have to literally drop to zero and never return, right? Because we're first, so it's hard in that. But as long as you're low leverage, your diversified pool, and you're doing your due diligence, and we're guiding around that 50 to 60% loan to value, you have a significant insulator from market volatility in real estate asset-backed debt fund. And what's exciting about it is those those loans that were originating used to be like 6%, 7% is what banks would be. Nowadays, banks are dialing back because they leverage too much in bonds, and the reason their deposits are leaving, so they're sluggish and slow. People don't trust getting loans from them anymore because interest rates are high, because there's a ton of demand, and because we have relationships and people trust us and we move quicker. We can charge much higher interest rates. So now we're like 13% is the last loan we just originated, plus 2 points for 6 months, with another point for the next 6 months on 50% loan to value property, and less than that actually. And so it's those are like equity-like returns 2-3 years ago, but they're on debt now, right? So it's incredible the risk-adjusted return you can get on a debt product. And so that's why some of the investors are worried about risk. Well, in recessionary times, you can invest lower on the capital stack instead of being in the volatile common and being on the debt. And then the debt fund, we can give you senior secured notes, which are fixed, 90-day, 180-day, 1 year, or Class A shares, which partner on the upside. So you can have a higher return, a little higher risk profile in a pool of debt, or you can have fixed returns. And so there's really something for everybody, I think, in that side.
Yeah, thank you for sharing that. It sounds to me like you guys do a really good job of, being well capitalized, protecting, on the downside. As it relates to your common equity partners, what does the communication cadence typically look like, with those investors? Are you providing them with monthly updates? Are you giving them access to the same, level of transaction detail, that you provide to the bank? What does that kind of look like?
So within both of them, they're large. The intention is, large diversified pools. So though there isn't like a tier point within the acquisitions fund, do we, as our plan, not that we wouldn't, but as our plan to show the independent financials of all the assets within the fund, nor would any investor in their right mind want to see that, the aggregated financials that wouldn't go to banks, because that wouldn't be, but we do share. Most of the time we provide dialogue updates, on a monthly basis, financials on a quarterly basis. And both the income fund and the acquisition fund are administered by Opus, which is like a $20 billion fund administration company held out of Ireland that does audit-friendly packages for, so it's all administered by the Bank of Ireland. And so, interestingly enough, but that allows us to, have a reputable balance sheet that is auditable, which family offices and institutions find that more friendly and safe.
Yeah, many investors that I talk to, I get the general sense that they're chasing after the equity multiple, or they're chasing after the internal rate of return, and they're not as focused on the day one cash flow, right? What would you say to that investor that is evaluating deal A and evaluating deal B? Deal A has a higher equity multiple internal rate of return, but deal B, while the projections may be lower, it's going to start paying cash flow from day one?
Well, so I would say from when I first started in this business, I was always about allocation. If you look at my passive investor guide, it kind of shows the charts of how the middle class, the high income, and the ultra wealthy invest, right? And so ultimately in alternative assets, you see 25 to 50% for the high income and the ultra wealthy. And that includes real estate. If you look at it, the middle class, it's 7, right? 6% in fixed income, right? And then in the middle class. And then it doesn't change much actually as you go through. There's kind of this allocation. So, and then you look at Tiger 21, all this is on my website, it's allocation, and it corroborates 26% in real estate and 7% in fixed income. And so the really allocations, there's really one piece that's missing there. Are you cash flow and are you growth and your liquidity needs, right? And aside from risk, right, you got to balance that risk profile. But that's why right now it's really tough to find those cash flowing deals. Why is that? I've got an article in Forbes that talks about inflation, right? And how multifamily can be a hedge when you have balanced debt that doesn't grow, and when you control, your expenses, and you don't have major, but there can be a hedge. However, what we've seen is the expenses have grown and the debt has grown in many of these. And so when you do new deals today, the interest rates just sucks out most of the cash flow. Harder to do on the first deal is get cash flow that's acceptable to investors. I've seen a lot of deals that are like 3%, 6% first year, and that's high for deals that pencil right now on acquisition standalone investments, right? So, but that gets you growth, right? That gets you the growth you need. So the allocations is what I look at is really need to be diversified in and out of real estate, but through this stack of your liquidity needs and your cash flow needs. That's why in the income fund we have a 90, 180 in 1 year note that right now does 8.5, 10, and 11% annualized, and those are fixed notes. But that gets you investors fixed income, but with liquidity, like not further than 90 days away from it, right? Gets them out of their bank account where they're worried about a collapse, or out of their brokerage account, or CDs where they're not meeting inflationary, the true inflation's hitting today, and into a senior secured note, right? Cash flow, immediate cash flow, or A-class shares in that. October return was like 14.9. Annualized return 14.9. It's pretty high just for debt, right? So but that's 3-year lockup. So if you want cash flow, that's a different product right now. Where debt used to be, 3, 4, 5%, 6%. Now it's higher. Where you used to be able to get 10% in multifamily, now it's at 3, 4, 5%. Those have inverted, right? But there's no growth in income, right? So the balance is between doing the equity plays, right, allocating, and a piece of shorter term liquidity and longer term to get cash flow and do growth. And I don't think you should try and make one size fits all. Multifamily deals just simply don't pencil. And if you look at the allocation for cash flow, and if you look at the allocation of the wealthy, they had 7% in fixed income. That's not tax advantaged, right? And it's important to not let the tax advantages control you, not let the tail wag the dog. Tax advantage for a reason, they're more risky, but your whole portfolio shouldn't be in those more risky allocations, right? So I think that I try and pull people away from that. Don't force it. Don't look for that deal that doesn't exist. It's too good to be true, that cash flows and grows. Like the equity growth we see in the acquisitions fund is phenomenal. Eventually it'll cash flow because you got your one investment we put into a bunch of properties, but no, it's not a cash flow focused fund. It's for growth. And I don't think you should try and make, those two all in one.
Let's talk about diversification, right? And when I say diversification, I'm not referring to diversification within real estate, whether you're chasing the cash flow investments or the growth, type strategy. Let's talk about diversification as it relates to Wall Street and Main Street. What type of advice would you give to that investor that maybe has never passively invested before into real estate, and they're considering doing that, but the entirety of their net worth is currently wrapped up in Wall Street or cash sitting on the sidelines underneath their mattress?
Literally in their home, right? Or in home equity. So most of America's wealth is in their home equity, or it's in their retirement account, right? And you also mentioned in their bank account, right? And they're losing with inflation because published inflation is like 4 or 5%, but that's corrected out all the things that matter, food and oil, which those are both high. So we're looking closer to 8-9% for non-fake adjusted inflation, right? So Yeah, so I have articles in Forbes, and so if you go back to my passive investor guide, which is a download, it does talk about the allocation strategies. Like I was talking about, it shows the charts and what you would have in private equity versus fixed bonds and fixed income uh, versus in real estate with 26 and then like 24 and then 7. It's like it's all there. So I talked to I'm really a diversification guy, and that's why we have a diversified energy fund, because it provides for de-linked alternative investments, right? And non-correlated asset swings are up and down. But I do tell people, if they're all in at Wall Street, that you could, what they don't realize is it's not that hard to unlock the majority of their wealth. I don't believe in, for your home equity, I don't believe in HELOCs. I'm not a fan of that. It's actually not a real good time to refi. But I know that there are investors that are looking like, look, I have, $5 million or $1 million or $500,000, and they do refi out. I wish you'd have done that like 2 years ago. It was much more common 2 years ago. But so that home equity is tough. But people that did HELOCs a year or two ago are really struggling now because those interest rates have gone up. So it's harder now to tap into the home equity, although the home equity is one of the most dangerous places to put your wealth. And that's because it is completely exposed. Like me, if you get in a car accident, they can sue you and come after your personal assets. When I did investment back in 2006 and 7, and it went under, I was personally guaranteeing, which means they could come after my personal assets. So home equity is really not a safe place. It's better to diversify that. But the easiest win is in your retirement account. If you go to Forbes, Patrick Grimes, IRA, I have a whole article, I have a guide on my website, how to carve out a piece of your retirement funds and then allocate it to try and meet that. Start investing like the middle class and ultra wealthy, and you can see those on my website. But it's simple, and we got a ton of partners that we use all the time. People take a piece of it, put it in a self-directed, and they can put it in gold, they can put it in silver, real estate, Bitcoin, whatever you want. Like I don't recommend a lot of those things, but getting it all out of the wild ride of Wall Street, especially now, because right now I think in real estate, it's one of the most extraordinary buying opportunities. And I missed 2009 and 10 because I was being drunk through the gutter, having lost it all. But now it's very different. And if people are willing to allocate out, there's tools to be able to do that. And I'm happy to talk to anybody to help along that journey.
Yeah, I couldn't agree with you more that now is a unique opportunity in real estate to either get started or to continue to dollar cost, average. I got my real estate investing journey started in 2012. So I've seen some ups and some downs, over the course of that, time period. But, depending upon who you ask and the market that it's located in, there are certainly some assets that have, valuations that have dropped, 20, 30, 40%, depending upon, again, the location. So, Patrick, you've provided a lot of tremendous value to us today. What would be maybe the next item on Patrick's bucket list that you're looking to check off either professionally or personally?
Well, so my wife and I, we just spent 4 months in Hawaii, a little over 4 months. And so we just got back to our home in Orange County, Southern California. So we just got done checking off our Hawaii stay, and we have our 11-month-old. And so we're looking forward right now to spending the holidays with our extended family here in Southern California before we plan our next journey.
Good. Well, welcome back to the mainland. And so my next question then would be is, how can our listening audience connect with you to learn more about what you're up to? Obviously give a shout out to the book that you wrote or you authored as well.
Yeah. So if you go to Passive Investing Mastery, Passive Investing, and then Mastery, all spelled out, .com/book. And I did do a book, as we were discussing earlier, and I co-authored it. In my chapter, it's Persistence, Pivots, and Game Changers, Turning Challenges and Opportunities. And it did make a bestseller. It was a lot of fun. Even Phil Collin, lead guitarist of Def Leppard, is in there. Actual rock star, NFL, NBA players, some entrepreneurs. It was just so much fun writing this with such extraordinary people. That I'm happy to share the story, because I tell my whole background, the ups and downs, the engineer back and forth, and how I got out. And so I'm happy. We send a signed hard copy out for free to all those who are interested, just as a give back. And if you want to set up a meeting, happy to talk to you right there on my website. You can do that even if you're not an accredited investor and are all in Wall Street. I mean, I'm happy to talk to you and just share backgrounds. Part of what I love to do now is be able to contribute back. And it's passiveinvestingmastery.com. And, my email is Patrick at that same URL. So happy to chat with anybody along the way.
That's great. Well, we will put those notes in the show notes for this episode. So again, Patrick, really appreciate you jumping me and joining me in on the show today.
Yeah, thanks so much. It was a great chat.
Yeah. And Freedom Point podcast listeners, thank you again for jumping into another episode of the Freedom Point. Look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.